Imagine this. The live market is running and suddenly you see not one, but multiple fair value gaps forming on the chart. Here's my question for you. Which one do you think the market will actually respect? Take 3 seconds, think about it, and drop your answer in the comments. Now, if you couldn't spot the smart money entry, don't worry. Because in this video, I'm going to break down exactly how smart money really trades FVGs. We'll start from the very basics, move into live chart examples, and I'll even share some secret tips and tricks along the way. So, welcome to the very first video of SMC Unlocked, where we decode smart money concepts in the easiest and most effective way possible. Before we jump into the actual breakdown, let's quickly understand the structure of this video. To keep it super beginner-friendly, I've divided the content into 5 clear parts. In part 1, we'll learn what a fair value gap actually is and why it forms in the market. In part 2, we'll explore how to draw FVGs on the chart. And yes, I'll show you exactly how to plot them live. In part 3, we'll dive into how to trade FVGs with smart strategies, so you'll know the step-by-step process. In part 4, we'll go back and discuss that very first question I asked you at the beginning of this video. And finally, in part 5, the most important one, I'll reveal why 90% of traders lose money while trading FVGs and how you can avoid those mistakes. So make sure you stay with me till the end, because every part connects to the next. Part 1, what is a fair value gap? FVG. Before we dive into fair value gaps, we first need to understand market states. The market is constantly moving in a loop, from balance to imbalance, and then back from imbalance to balance. Now, let's understand this through a chart. Here's how it works. When buyers and sellers are roughly equal, the market stays in a balanced state. But the moment buyers suddenly outnumber sellers, the market breaks that balance and shoots upward, moving from balance into an imbalanced state. This creates a bullish imbalance as buyers push the price up rapidly. On the flip side, when sellers significantly outnumber buyers, they drive the market down quickly, creating a bearish imbalance. Think of it like this. The market can get stuck in an accumulation zone where buyers and sellers are roughly equal. Then suddenly, buyers push aggressively upward, hitting sellers' stop losses. This forms large bullish candles, and the gap between 2 consecutive candles is what we call a bullish fair value gap, showing where buyers entered above the fair price. Similarly, when sellers dominate, they push the market down, hitting buyers' stop losses, creating big red candles and a bearish fair value gap, showing where sellers sold below the fair price. So in short, fair value gaps are the imbalances created when the market moves quickly from balance to imbalance, and you can clearly see them between 2 consecutive candles. Part 2, how to draw an FVG on the chart. Okay, so let's talk about fair value gaps. It's actually super simple. A bullish FVG is just a 3-candle pattern. Look at the high of the first candle and the low of the third candle. The gap in between, that's your bullish FVG, easy, right? Flip it for a bearish FVG. Take the low of the first candle and the high of the third candle. The gap between these two is your bearish FVG. Now, if there's no gap between the first and third candle, don't worry. It just means the market is balanced, nothing fancy happening there. And here's a little pro tip. Sometimes a big candle can have a smaller inside candle. In that case, always go with the master candle. So your bullish FVG will be measured from the high of the master candle first to the low of the third candle. See? That's it. Super simple, and you can start spotting these on your chart right away. Part 3, FVG trading strategies. All right, now we're at the part traders have been waiting for, FVG trading strategies. In this part, I'm going to teach you 4 powerful FVG strategies. And don't worry, we'll keep it short, simple, and super easy to follow. Strategy 1. The FVG must be unmitigated. Let's see this on the chart. Here's our market, and you can see a fair value gap forming. Whenever an FVG forms, it basically signals that price will come back to test this gap and then continue its trend. This means an FVG can only be used once. If the price comes back and touches the FVG, it becomes mitigated. And once that happens, it's no longer valid for trading. So, the golden rule here is trade an FVG only once. If it's already been tested, leave it alone because it's now invalid. All right, let's move on to strategy 2, the midpoint rule. Let's see it on the chart. Here's our market, and here's the FVG. Now, how price reacts to the fair value gap is actually decided by where the candle closes inside the FVG. Here's a pro tip for you. We use something called CE, consequent encroachment. Don't get caught up with the fancy term, just know it's the midpoint of the FVG. So first, mark the midpoint on your chart. Now, whenever price comes back to test the FVG, if the candle closes above the CE, that FVG is valid for trading. This tells us the market is strong, and a powerful move might follow. If the candle closes below the CE, don't trade it. This shows the market is weak and the trend might reverse from here. Remember, CE tells you if the FVG is strong or weak, trade only when it's strong. All right, let's move on to strategy 3, the third candle rule. Let's say we have an FVG forming here. The strength of this FVG actually depends on how the third candle forms. Here's the key. If the third candle is a big dark red candle that eats up more than 60% of the FVG, there's a high chance that this FVG will fail because it signals a weak FVG. So whenever you spot a bullish FVG forming, make sure the third candle is also a strong bullish candle. This gives you a confirmation that the FVG is valid and strong, and increases your chances of a successful trade. All right, now let's move to my favorite strategy, the HTF to LTF rule. Here's how it works. First, mark the FVG on a 1-hour time frame. Since the time frame is big, the FVG is also large, which means we can't just trade it every time price touches it. Now convert this 1-hour structure down to a 5-minute chart. Here's the catch. Most new traders make the mistake of directly drawing the FVG on the lower time frame and trading it. That's a wrong approach. Instead, wait for the leg that breaks the market structure. Then, draw your FVG inside that specific leg. Finally, when the price comes back to test this FVG, that's your perfect trade setup. It's simple, effective, and one of the most reliable ways to trade FVGs. Part 4, answering the first question. Which FVG to trade? Now, let's finally discuss that first question I asked you at the start. If there are multiple FVGs forming in the same leg, how do we decide which one to trade? Whenever you see this pattern on the chart, the first thing we do is mark the premium and discount zones. Since we're in a bullish trend, only the FVGs inside the discount zone are considered valid. All others automatically become invalid for us. Next, check for key zones like order blocks or breaker blocks within that discount area and mark them. Any FVG forming there is now considered valid. Now, suppose we're left with 2 potential FVGs. Which one should we trade? Here's the golden rule. Always look at the true day open. In a bullish setup, entries should always be taken below the true day open. Watching how the market reacts, you'll see it approaches our valid FVG and gives a strong move. Most new traders make the mistake of trading every single FVG they see. They hit multiple stop losses before getting the right one. But, as you can see, FVGs do work. You just need to trade the right ones in the right way. Part 5, avoid trading in consolidation phase. Now we've reached the most important part, the exact reason why 90% of traders end up losing money. Here's the deal. Making money in the market is actually easier when the market is in a clear trending phase. All you need to do is follow the trend where your bullish FVGs are being respected. But here's the catch. Sometimes, even when the market is in a trending phase, a bullish FVG can fail. And what do most traders do? They immediately flip their strategy, switching from uptrend to downtrend. Now the market might form a downtrend, so logically, you'd expect the bearish FVGs to work, right? But often, they don't get respected either, and the FVG fails again. Whenever this kind of pattern appears on the chart, it's a clear signal. The market has entered a consolidation phase. And here's the golden rule. Stay away from trading in consolidation. This is where for today's deep dive into fair value gaps. If you're serious about learning how to trade like smart money, join our 45-day trading challenge, a structured journey where, in just 45 days, you'll learn to trade step by step with real examples and practical strategies. On this channel, every alternate day, we'll post a trading challenge where traders can learn together, share insights, and help each other grow. Also, if you want more live chart examples on this topic, I can upload them in a PDF for you. Just drop a comment and let me know. Remember, learning to trade the right way takes practice, patience, and smart guidance. And that's exactly what we aim to give you here. This is SMC Unlocked, decoding smart money concepts in the easiest, most effective way. See you in the next video.